Hello, welcome to this week's podcast, and joining me and my good friend Michael Brown for this week's look at the events of the last few days. And once again, it's been another choppy week for financial markets. Also, the end of the first quarter of 2026, and there's been a lot to, I think, chew over, hasn't there, Michael, in the past 3 months?
Yeah, the statement of the year right there. Very good afternoon to you, mate. Good afternoon to everyone else. The longest first quarter ever has come to an end. Well, if the first 2 days of April are anything to go by, we're about to start the longest second quarter ever as well. There's certainly no rest in terms of the relentless news flow and the headline whiplash that we're all suffering with. And yeah, certainly looks like that's going to carry on, not only on the geopolitical front, but we're a week or so away from the start of earnings season. We're going to start getting some of the economic data that will paint a bit of a picture as to the early impact of the conflict in the Middle East. So yeah, plenty to chew over once again.
Yeah, so we've got quite a bit to get through, obviously looking at the market movements in the context of the last quarter, the fact that the FTSE 100 and the Nikkei have stood out as the only two indexes to actually finish the quarter in positive territory, pretty much unlike the rest. I'm surprised Labour hasn't claimed credit for that. But I suppose it is their fault, really, given the fact that energy prices have spiked so much.
Yeah, exactly. Probably not the reason why they'd want to claim credit for things, but yeah, we will give them credit.
Yeah, I think a better benchmark is the FTSE 250, and that has.
Well, they wouldn't look at that because it hasn't gone anywhere.
Exactly. Anyway, let's do the risk warning before we get into a variety of topics as we head towards the Easter break. Okay, this content is for general information purposes only and does not take into account your personal circumstances or your objectives. Nothing in this material is or should be considered to be financial, investment, or any other advice on which reliance should be placed. The material has not been prepared in accordance with legal requirements designed to protect the independence of investment research. Okay. So, yes, as you rightly said, we've had inflation data out this week from Germany, France, and the EU. Not a pretty picture. Obviously, we've got US inflation next week, and it's likely to be a similar story. We'll look at that in the context of the week ahead. Obviously, we'll also look at this week's US economic data, which by and large has been pretty positive, ahead of payrolls tomorrow.
Yes.
Looking at UK markets, we've had some data out of the UK this week. Obviously, we've had the final print of fourth quarter GDP, which hasn't really told us anything that we don't already know. Stagnant economy. We saw a pickup in mortgage approvals in February, as well as the latest lending data, but obviously all of this data predates events in the Middle East. Since then, we've had a whole host of mortgage products taken off the market, and mortgage rates have jumped to the highest levels in 2 years, as well as a whole host of mortgage products being taken off the market. We're going to have a quick talk about the Unilever deal with McCormick selling Marmite and its foods business. I think it can be universally acknowledged that markets don't like that particular deal on either side of the pond, and we will talk about that. Raspberry Pi's full-year numbers saw a massive surge in their share price this week on the back of some fairly positive numbers, as well as some really punchy guidance. We'll also look at Nike's Q3 numbers, which just didn't do it for investors.
Right. 4 minutes in. I thought I saw that in your notes. I thought you might at least wait until we got to that section. God.
So we'll talk about
Bring
that.
on the Easter break. Make it quick.
Oh dear. Maybe we should edit that bit out.
Oh,
anyway,
no, leave it in.
Leave it in. And then we're going to look at the week ahead. We've got obviously US CPI, we've got UK services PMI, the final numbers, we've got Fed minutes, as well as fourth quarter GDP, the final numbers for that. And if we've got time, we'll look at Delta Airlines first quarter numbers, along with the, we've also got Constellation Brands and Levi Strauss, but again, only if we have time. Okay, so this week we've seen stocks up, bonds up, dollar up, gold up, oil all over the place, although today we've slipped back some.
Yeah, yes. It's all been, well, I mean, you say that on its own, and you would kind of assume that the narrative is world peace. And I think the market is kind of hopeful that we're, I guess, coming closer to the end of the conflict than we are the beginning. There have been some signs throughout the week that President Trump is increasingly looking to bring, kinetic action, for want of a better word, in the Middle East to an end. There's been a lot of talk around this kind of idea of separating the US's withdrawal and the issue of reopening the Strait of Hormuz. Trump kind of going, I've made the mess, but you lot can go and clear it up for me. However, that has kind of changed and really turned on its head today because, of course, we had Thursday, we had the overnight primetime TV address from President Trump, where I think the market was hoping for a bit more meat on the bones in terms of how he plans to de-escalate things, a time frame for bringing the war to an end. And Trump didn't really give that. In fact, he didn't really say anything new, and I think the market didn't get what it wanted. So we're seeing again today the opposite of that. Stocks down, bonds down, the dollar is a little bit firmer, gold down, and oil is charging higher at the time of recording because the market has had 2 days of being optimistic about the conflict coming to an end and is now unwinding most of that.
Yeah, I mean, how likely is it that Trump is going to follow through on his threats that he could basically just walk away and essentially do the equivalent of taking a crap on his own doorstep? You know, leaving the Saudis and the UAE to basically pick up the pieces. I think, this is my tuppence worth here, that's highly unlikely because that would go against everything we know about Trump. He's driven by personal ambition, he's driven by money. And in 2025, he signed a huge number of commercial deals, not only in Saudi Arabia, but also in the United Arab Emirates. Particularly in Dubai, where he agreed a deal to open one of his hotels. Now, if he basically walks away, I think you can pretty much put every single one of those deals in the wood chipper.
Yes, I think you probably can. To be honest, I can make an argument that he would do it. I can make an argument that he wouldn't do it. I think it just speaks to a degree of desperation to bring this thing to an end. And
I think
almost
it would cost the US a fortune.
Well, it would, and we can come on to that in a second, because I think, ultimately it all signals that Trump does want to somehow get this over and done with. I think they've realizing that they've bitten off a little bit more than they can chew. The Iranians have responded in a way that they probably weren't bargaining for, and that is why we now see them sort of scrambling around to look for any off ramp that they can possibly try and find, however desperate that may seem. There is, of course, Trump keeps saying the US isn't reliant on the Strait of Hormuz, go and get your own oil to European countries. Well, it's all well and good saying that, and yes, the US is a net energy exporter, but if the Strait of Hormuz remains closed or impassable, if oil supply does continue to be interrupted, then that is going to have a significant adverse impact on the US economy as well. Maybe not to the same magnitude that you might see here in the UK or in Europe, but it's going to be a stiff headwind for the economy to deal with into the midterm elections.
Well, I mean, it's not just about oil and natural gas, though, is it, Michael? And this is something that I think gets really overlooked. The world's global polyethylene capacity, pretty much 80% of it, or over half of it, comes through the Straits of Hormuz. Now, what is polyethylene? It's essentially any type of packaging, bag, bottle top that essentially contains foodstuffs or any other item. So that is going to have a significant upward effect on inflation going forward. 50 to 80% polyethylene prices have risen over the course of the past few months. That is going to sharpen supply chains. Helium, which is crucial in the manufacture of microchips, that's going to affect Nvidia. It's going to affect Amazon. It's going to affect every single technology producer all over the world. So, and that's before we even talk about fertilizer.
I was just about to flag fertilizer. That's the other one that arguably isn't getting the attention that it needs to get at this point.
So for him to pretend that somehow it's not going to affect in the US is wishful thinking in the extreme. Yeah,
I completely agree with you. It's a soundbite that looks good on social media and probably plays well with the base in terms of his political supporters, but it does not reflect the reality of the situation on the ground in either the US or the global economy.
Having said that, shifting away from all of that, the US economy doesn't appear thus far despite the fact that gas prices have risen over 30%. Gasoline prices, I should say, not gas prices.
Yes,
Gasoline
petrol.
prices. Petrol to you and me have risen over 30% since hostilities broke out, and you've now got US unleaded at over $4 a gallon in some places.
Still a hell of a lot cheaper than it is here, may I add.
Oh yeah, it's about 80p a litre.
Yeah, exactly. Which says it all.
But it is starting to show up in some of the inflation numbers. I mean, the US economy the jobs market looks fairly decent. Decent, it's relative, right? Okay, jobless claims 202, lowest in almost 2 years.
Yeah.
ADP 62. I know your favourite jobs number.
Well, we get the official jobs numbers tomorrow, but the BLS have annoyed me with that. I mean, which genius at the Bureau of Labour Statistics decided that they should drop a non-farm payrolls number on Good Friday? I would love a word with them about that. But you are right. Thus far, we have seen a little bit of a hit to consumer confidence and consumer sentiment, but that's really the only notable dent in the US economy that we've seen in any of the data that we've had covering this period since conflict began. Jobless claims are still very low. The labour market seems to be sort of ticking along okay. We haven't had retail sales for March yet. We'll be getting those in a couple of weeks. That will be something worth watching very, very closely indeed. And of course, we will be getting the CPI numbers next week, which will give us an idea of the impact of the energy shock. But, right now, you can't really point to there having been that much of an adverse impact, but you kind of got to assume that this negative demand shock is going to have an impact at some point in the future. It's a matter of when, not if.
Yeah, I think we saw that in the prices paid number in the manufacturing report earlier this week, didn't we? Highest in 4 years.
High, wasn't it? Yeah.
Yeah.
Yeah, we get
78.3.
Yeah, and we get the services, ISM services survey on Monday, on Easter Monday. I think for me, it's not necessarily, I'm not overly surprised by where the prices paid number is. Oil has gone up a lot. We know input prices have gone up a lot. We know the prices paid number is going to go up a lot. The key question is, how long does it stay there? And does it go any higher? And obviously, again, that brings us all the way back to when does the Strait of Hormuz reopen? Because that is basically the key to solving all of these problems and answering all of these questions.
It is and it isn't, and I think it's got a long tail as far as the US is concerned. I don't think we're going to see much of an impact until, say, for example, May, when we start to see the April numbers come up. But even if the Straits of Hormuz does open tomorrow, that's not going to mitigate what we've seen over the course of the past few weeks because of infrastructure damage.
Yeah, exactly that. And also, you've not only got the infrastructure that needs to be repaired, but you've also got a confidence deficit as well, where, the Iranians could well turn around and say the Strait of Hormuz is open and safe for passage. Are you going to, if you own a VLCC, are you going to be the first man to sail your ship through there? I would wager you're probably not. You're going to want to actually prove that passage is safe and have a number of vessels go through before you try to run the gauntlet as well. So it's not an on-off switch. It's a gradual reopening and a sort of sliding scale, I think.
Well, I think it also presupposes that the Iranian regime is talking with one voice.
Which is also no guaranteed.
And then, of course, you've got the Houthis who basically started to open fire over the Red Sea transit passage as well. So, there are no particularly good options here. And not every ship can sail around the Cape of Good Hope.
No. And of course, it goes without saying that we do hope that all of this, comes to a resolution and we do get some sort of peace agreement much sooner rather than later for the people on the ground and, of course, for the impact it's having on the economy. But yeah, I think it's one of those where the rhetoric doesn't quite tally with the actions at this point, and markets are slowly but surely today perhaps starting to reconcile themselves to that a little bit.
So let's look at Europe. Obviously, we've seen the latest inflation numbers out of Germany and obviously the EU broader measure of inflation. EU CPI for March went from 1.9% to 2.5%. German CPI number was similarly aggressive. But what I think what's particularly notable about this is that there had been an expectation that the ECB might be tempted to hike rates when they next meet. But
yes,
actually, Isabel Schnabel, the German member, has actually said Well, hold your horses. It
Mm.
seems to me that maybe somebody is learning something from previous mistakes.
Well, you'd certainly like to expect so. And this was last Friday, wasn't it? The comments from Isabel Schnabel. And the reason why these are so impactful is because, or were so impactful, I should say, and markets paired and now price around about a 50% chance of an April hike, whereas that had been pretty much fully discounted at one stage, is because Schnabel is not only an influential member of the ECB's executive board, she's also typically one of the more hawkish members on the board as well. So when she is saying things along the lines of, let's not overreact, we don't need to rush, we can take our time to assess what's going on, that's a pretty strong signal that actually, you're right, maybe, just maybe, there is a chance that the ECB are learning from having completely and utterly buggered things up twice in the past in a situation like this, and they may have actually realised what not to do the third time around. It was also interesting that we heard similar comments from the Bank of England governor this week, Andrew Bailey, who was almost as explicit as any central bank is going to get when they're commenting on these matters, and basically saying markets are going a little bit too far in pricing in rate hikes at this moment in time here in the UK. So I can, only hope that central bankers are waking up to the reality of the situation and aren't going to tighten policy into a demand shock, but only time will tell.
Yeah, but I've always thought this idea that the Bank of England could either hike rates or cut rates. The markets have already tightened monetary policy for the Bank of England.
Yes.
So why does the Bank of England need to do anything?
Well, I suppose the argument would be if they don't do anything, then the market will just unwind what it's priced in. But I do completely see what you're saying. I still just don't see any need to have a tighter monetary policy stance at this point, and we've covered the reasons for that at length. Frankly, interest rates do not determine where the price of oil goes. And when inflation is being driven by the price of oil, which is going to cause a growth headwind, you don't amplify that growth headwind by raising interest rates.
Well, the problem with hiking interest rates is essentially what they're doing is they're signalling even higher rates because the market will start into price further rate hikes.
Exactly that.
So it's completely self-defeating.
And this is where you then get to the point where actually if they were to tighten policy, they'd end up having to unwind it again. Because, let's say there's a scenario where, the BOE go rogue, for want of a better word, and they deliver a hike in April or a hike in June or both. You've then got bank rate running at 4.25%, which is undoubtedly restrictive. You amplify the growth hit to the UK economy. You're probably going to have to cut rates 3 or 4 times at the back end of 2026, early 2027 anyway, to make up for the mistake you've just made. So, yeah, it could end up getting very, very messy. But I would say again, we have heard somewhat more sensible language from central bankers this week than we did last week, which is reassuring, I think.
It's interesting that the UK 10-year yield hasn't gone back to 5%, which it was at the end of last week, even if the average 2-year mortgage deal has risen by almost 1% over the course of the past month or so to 5.77%, which is an 18-month high. So you're getting tightening there.
Yeah, and just you wait for Prime Minister Angela Rayner to rock up, and 10% will look low on 5% will look low on the 10-year yield. Maybe 10% would look low as well at that point.
I think there'd be a smoking crater where the economy used to be if rates went to 10%, mate.
I think you're right. But yes, just of course on that mortgage data, it was from February, so it is pre-conflict, and as you say, swaps have charged higher in terms of rates since then. Mortgage offers have been withdrawn, so the housing market's probably going to go into a little bit of a pause for the next month or so, at least, you would expect.
But that also has real-term consequences for those 5-year deals that are rolling off this year.
Yeah, anyone who mortgaged 2020, 2021, is refinancing from 1 or 2 to 4 or 5%. That's going to be a big chunky increase.
Yeah, and it certainly doesn't make it look particularly positive for the inflation outlook. It just strikes me as rather strange that we've still got the UK government pushing back against any reduction in VAT, any reduction in any type of energy or fuel duty, when countries like Italy, Spain are already implementing these sorts of temporary cuts to their headline, and Miliband's coming under increasing pressure. He's almost like a lone voice in the wind now. When it comes to drilling in the North Sea, and he's still peddling this idea that there is still a single price, a global price
Which is just
for natural
nonsense.
gas, which just drives me round the bend. So let's nail that lie right here and right now. This, ladies and gentlemen, is the US natural gas price, which is the black line. And you've got the EU natural gas TTF natural gas price since the beginning of February. If there's a global natural gas price, why are there two lines? And there's also a UK natural gas price, which would mean there would be three lines. Obviously, the UK natural gas price would closely track the TTF natural gas price. But look at the US price. It's negative. It's lower than when it started at the beginning of February. Look at the EU natural gas price. It's nearly 75% up from where it was 2 months ago. So all you people are saying there's a global natural gas price. Explain this, please, Muppets.
Yeah.
I'd love you to explain it. Because to me, even if you say that drilling in the North Sea won't lower these natural gas prices materially, the tax revenue, the investment and the jobs it will bring will improve the UK's balance of payment position. What is not to like about this rather than importing it from places like Qatar and everywhere else? I'm speaking slowly so it sinks in.
I was going to say, it's one of those where you're speaking slowly just so those at the back of the room can understand as well. But yeah, you're absolutely spot on. You know, that chart says it all. There is clearly not one price for natural gas. We're looking at two contracts. You can throw the UK contract and you throw whatever else on you want. You know, this whole argument is just utterly nonsensical. And actually, it does appear that Ed Miliband is increasingly isolated on this front, because I believe, I saw on the train last night, it was on my way home, there was something along the lines of him and Rachel Reeves are now even split on the issue. So, you know, maybe there is going to be some logic and some common sense prevailing in Whitehall at some stage soon. I certainly shan't hold my breath for that to happen, but we can only hope.
Anyway, rant over. Let's move on.
That rant. There'll be another one in a second, I'm sure.
Yeah, let's talk Unilever and McCormick. Marmite.
Another rant.
Another rant. What is the point of this deal? Because judging by the share price reaction, nobody likes it. It's a rubbish deal.
Well, do you know what?
Where's the value?
There is no point to the deal in terms of how it has been structured, because Unilever are running around saying, you know, we want to streamline the business, we want to focus on certain areas of the market. Well, why do you spin off a unit and retain 55% of it?
Yeah.
That doesn't make any sense to me. You know, if you were spinning it off and getting a decent price and just getting rid of it, then absolutely fine. It fits into your strategy, job done, crack on. But the fact that you spin something off and then retain a majority stake in it almost just defeats the object of the entire deal in the first place. You may as well just hold on to it.
Well, the biggest concern I have is McCormick, the McCormick side of the deal. They're taking over a business, right, that generates twice as much revenue than McCormick does. Certainly on a quarterly basis. In Q4 alone, the Unilever business saw a turnover of 3.3 billion euros. Now, the McCormick business over a whole calendar year turns over $6.8 billion.
Yeah.
So they're taking over a business twice as big, and they're also leveraging themselves up to the eyeballs
in order to
do it.
Yeah.
And, you know, why do Unilever shareholders want to take a stake in a business that has now become even higher leveraged than it was before? It just really makes no sense. And it's not as if US companies have a good track record.
Not at
when
all.
they come to taking over UK business. I'm talking Terry's, I'm talking Cadbury's, you know, and I'm talking Lee and Perrins. They make good British brands, decent British brands. Worse, I'm really struggling with my words today. I don't know. I think I need another cup of coffee.
But you know, ultimately, you are absolutely on the money here. There's not a lot to like about it for Unilever shareholders, because they're being lumbered with a stake in a highly leveraged business that apparently the Unilever board want to get out of. And there's not a lot in it for McCormick shareholders, because they're levering the hell out of the business to buy a behemoth that, you know, God only knows whether they're actually going to be able to control it. So, yeah, I honestly cannot get my head around that one. It's actually one of those where the market reaction makes complete and utter sense, because I think everyone is probably sat there just like us, scratching their heads going, who the hell is this good for? And I don't think it's good for any of the shareholders involved.
I mean, you've got the McCormick CEO, Brendan Foley, talking about maximal adjacency, actionable growth levers, and end-to-end flavor experiences. I mean, that's just a
I mean,
word
what the hell
salad of
does that mean in
nonsense.
English, for God's sake? That's someone who's swallowed a management consulting textbook and just regurgitating it into a press release, isn't it?
I might have to edit that bit out.
Do we have an expletive button on this program? We might need one.
I mean, McCormick shares are now 8-year lows. They've gone below their below their COVID lows. You know, McCormick shareholders don't like it. I don't think Unilever shareholders like it, and it's not
No.
due to complete until the middle of next year.
Well, this is the other thing. It's going to drag on forever. And it's also, it's not an environment to be doing deals, if we're being completely honest. Given how uncertain the outlook is, now is not the time to be involved in M&A and in deal making. Yeah, I just don't see anything to like here. Unilever's strategy doesn't add up either. We want to focus on health and personal care, but we're going to own a majority stake in a food business still. Well, come on, guys, make your mind up. Either you want to go down that route and stick to that strategy, fine, go on, stick with it. Don't have this sort of half in, half out approach.
But also, when you look at their previous M&A deals, Lipton's, the spreads business, the ice cream business, the share price is lower, having offloaded all three of those businesses in the course of the past 4 or 5 years. So where's the value add?
Yeah, well, I would assume that the market is viewing this as a case of, almost Unilever selling down valuable part and revenue generating parts of the business.
I think it's a mistake, because ultimately, I think the more diversified you are, I think Unilever's probably done as much as it can do. And I think this food business is a disposal too far.
Yes. And I think the market is sort of, telling them that in terms of the message it's sent with the share price declines that we've had since they started down this track. But they've gone too far now. And maybe that to some degree explains this kind of half-baked approach that they've taken to this deal, trying to somehow rein it in a little bit on the disposals front, but it's just not the right way to do it.
Well, let's hope it falls through.
Well,
because I think Unilever shareholders may have a say in this particular deal.
Well, Mr. Regulator might want to have a say in it at some point as well.
Yeah, I'm not sure about the regulator. The regulator tends to be fairly toothless when it comes to these things, and essentially, where's the conflict here?
Yeah, true. Well, anyway, we've got a year to find one, so some budding young lawyer somewhere will go digging into it, I'm sure.
If I was a Unilever shareholder, I'd probably be selling my shares, either that or voting against this particular deal, if I'm given a say on it. Anyway.
I would definitely vote against it, that's for sure.
Okay, Raspberry Pi, British success story.
Yes.
Full-year numbers, really decent market reaction to them. 25% increase in revenues, and profits before tax up 63%.
Yeah, and the stock's trading to its best levels since, in about a year, May 2025 , isn't it? So
yeah, it did spike a little higher in February on the back of those open claw.
Yes, you're right. Yes,
open claw headlines.
Yes.
But yeah, I mean, it certainly closed at the highest level in over 2 years. So, certainly on that basis.
Yeah, I think the issue for Raspberry Pi, and I think this might be a bit of a harbinger for what we're going to see elsewhere in terms of semiconductor names, is the issue is not going to be demand. Demand is resilient. We know that. Demand is going to increase. We know that. The issue is whether they're actually able to meet that demand, because, as you mentioned earlier on, there are issues in terms of the supply chain for semiconductors, whether that be helium or whatever else coming through the Strait of Hormuz. That is going to pose an issue in terms of being able to meet the demand that is out there, and that's really the key hurdle that they're going to need to jump over.
Yeah, their revenue guidance was pretty punchy for 2026. $500 million from 323.2. I mean, that's punchy.
It's incredibly punchy, particularly given the disruption that could be going on. But companies don't overpromise and underdeliver; they do it the other way around. So you've got to assume they've got some confidence in hitting it.
Well, I think they could probably hit the revenue target. I think the biggest concern I have is how much it costs them to hit that target.
Yeah, so what does the EBITDA then look like?
Yeah, exactly. Yeah. Because I think they could probably meet that target on the basis of higher prices. But in terms of generating that revenue, how much are they having to pay for DRAM?
Yeah, exactly that. Because there's still a global shortage going on. Again, these are all of those little issues that markets have not necessarily forgotten about, but just can't focus on at this moment in time, given everything that is going on elsewhere on the geopolitical front, etc. That these shortages are still going on, and at some point, once the geopolitical noise is dialed down a little bit, we will refocus back on that, I'm sure.
Indeed, and let's move on.
You're not going to do this pun again, are you? Can
No,
we
no,
just
no, I'm not
switch
gonna
past that?
no, well,
It might have been
Nike sh
worse, actually.
Nike shares, I mean, fairly decent set of Q3 numbers, but yeah, they just didn't do it for me.
The
Or the
guidance.
market for that matter.
Yes, dearie, we'll gloss over that.
Yeah.
The guidance was the problem there, I think,
8-year
wasn't it?
lows now.
Yeah, and they're down 30% already this year, and we're only on the 2nd of April.
Mm.
Yeah, I think, as I say, it was the guidance that was the issue. You know, they are forecasting low single-digit revenue growth for the entirety of the calendar year. And of course, remember, it's a consumer discretionary name, and if you are dealing with a potentially slowing US economy, or a slowing global economy, in fact, then that is not going to do consumer discretionary stocks much in terms of doing them a favours. Even though the figures were actually fine, despite what we see in China, which we can get onto, you know, the issue is that they are stale. Again, they reflect a world that doesn't really exist anymore, and there are headwinds on the horizon, I think.
Yeah, I think the thing that struck me about this, Michael, was the fact that direct-to-consumer revenue was down, but wholesale was up. Now,
Which is
usually that's the
interesting.
other way around.
It should be the other way around, you would
Yeah.
expect, yeah.
But it's not. And obviously the business in China continues to act as a drag, and they're continuing to blame tariffs for the erosion of their margins.
Which I understand, but it increasingly feels like a bit of an excuse now.
Yeah, it's not exactly new, is it? And it's not exactly unexpected. So,
Well, no, it's not new. And today, the 2nd of April, 2026, is exactly a year since Liberation Day. So, you know, by this point, come on, guys, you know, yes, we know tariffs are a greater cost, but you've had a year to adjust. Let me be clear, I'm not a fan of tariffs. I think ultimately it's a bit of a zero-sum game. However, in this instance, the tariffs are there. It's now on the companies to adjust to them. And if Nike haven't done that, then that's their problem, I would argue.
Or they either haven't or they can't because no one's buying their product.
Which, again, is a problem that they can solve, not anyone in the government with their tariff decision.
Indeed. Okay, well, let's move on to next week. US CPI. Expectations are pretty punchy, mate.
Yeah, 3% on the headline, wasn't it? I'm going to now have to hurry and find the WhatsApp message that I sent you because I didn't write it down myself.
2.4%, gone from 2.4 to 3.3. Now, that's more than the rise year on year that we've seen in Germany and the EU, despite the fact that natural gas prices in the US are low.
Indeed. We are starting, obviously, from a bit of a higher base, but you're absolutely right. Get just the core inflation metric, that's seen at 2.7, and that was at 2.5% last time out. So obviously, when you strip out energy and food prices, you obviously get a lower figure. I think we are, you know, still very much at the point, though, where the Fed are very much likely to look through the data. We actually heard from Fed Chair Powell earlier on in the week saying that we're well positioned to wait and see what happens. That had actually a bit of a calming impact on the Treasury, in the front end of the Treasury curve until today, and also on money markets as well. Swaps now back to pricing in rate cuts from the Fed this year. I think we've got about 15 basis points of cuts discounted by the end of the year. So I think it's important not to overreact to what the inflation numbers say next week. We know that headline inflation is going to go up because energy prices have gone up. The key things for me are, one, how long does inflation stay somewhat elevated? And two, do we start seeing higher energy prices sort of seeping in to other components of that inflationary of that inflation data? Do we see evidence of those second round effects? Because if we do, that's when you start to think about a policy response potentially being needed. But unless we do see that, then I think the Fed are going to, sit on their hands for as long as they can, to be honest.
Yeah, I mean, you say that the markets are starting to price in potential rate cuts. I think if inflation jumps as much as the market estimates it will, then the focus will shift away from the labour market back to inflation again. If, obviously, payrolls tomorrow posts a fairly decent number, and I think what are the estimates, about 60k?
65 on the headline payrolls metric, 4.4% unemployment. But, this is again, and I will stress, I do not view this as my base case, but this is where you start to look at, do we end up in a scenario where, the hairs are running on the stagflationary narrative again, market participants potentially worried if we do get a soft a soft jobs number and a hot inflation number. The dual mandate goals start to come into tension a little bit. How does the Fed react to that? That's a bit of a nightmarish scenario for new Fed chair Kevin Warsh to be taking over. And I think his silence has been very, very telling, I would argue, over the last, 3 months. We haven't heard from the fellow since he was nominated.
Well, he can't really say anything, can he? Because he hasn't been confirmed yet.
And they haven't even scheduled a date for his confirmation hearing.
Because of this Department of Justice thing against Powell.
Yeah.
Which, yeah.
Do you know what? If I were Kevin Warsh right now, I'd be almost egging the Department of Justice on to drag this out as long as possible, because you do not want to be taking over at the Fed or any central bank in the middle of this. It's a bit like Andrew Bailey when his first day at the Bank of England was about a week before lockdown. I mean, talk about being thrown in at the deep end.
Yeah, and especially given the fact the midterms are coming up and Trump will be screaming from the rooftops for the Fed to cut rates.
Well, he already is with Jay Powell. And of course, the other sort of change to that dynamic once Kevin Warsh comes in is it's not too late Powell, who I've hated for years. It's Kevin Warsh, who's the man who sat in the Oval Office 3 months ago and told me he'd lower interest rates. So, that I think that could get very, very nasty indeed if Warsh weren't to deliver interest rate cuts. I think Trump, you see the abuse and he's given Powell and how badly he's taken that. I think, many, many orders of magnitude greater in terms of the criticism he'd probably be lobbing Kevin Warsh's way.
Yeah, but 3 months ago, the US wasn't firing missiles at Iran.
Do you think that matters to President Trump? This guy's a real estate developer. They've got the best economy in the world. It means they need the lowest rates.
Nah, does it?
You and I know that because we're logical and we approach things with a rational mind.
Yeah, indeed.
On
Anyway,
that note,
on the note, Fed minutes.
Yes, exactly. They are, of course, they all are always stale, but this time even more stale than usual, given that, basically a sort of century's worth of developments have happened in the last 3 weeks since the March FOMC. Obviously, they did keep rates unchanged. It was an 11-1 vote, just Stephen Myron dissenting for a 25 basis point cut.
I thought Waller did as well.
No, he didn't. No, he was he held steady at the March meeting.
Are you sure about that? Because I've got it down as cutting rates. Okay.
I will bet a pint with you that he did.
Okay, fair enough.
So, in any case, I don't think the minutes are going to be especially instructive. The Fed are in this wait and see mode. They'll probably flag that there was concern over energy prices, that they're worried about how upside inflation risks could evolve. But, realistically, is there going to be any signal in that document? I struggle to see it.
Okay. UK services PMI, we pretty much know what that is going to look like because we saw the flash numbers, I think, was it last week? Or was it earlier this week? I can't remember. The weeks tend to sort of
blur
merge
into one at this point.
Yeah. They do. But higher costs, new
slower
orders,
activity.
slower activity.
Yeah. And I think the composite PMI was a 6-month low per the flash index. And if anything, they'll probably be revised lower because, again, the news flow hasn't really materially improved in the period between the flash survey and the final survey. So, that's kind of a logical expectation, I think.
And we got the fourth quarter GDP final reading from the US, which obviously was, I remember having a conversation with you, I think a few weeks ago that, wasn't it the Atlanta Fed had US Q4 GDP at 3%?
Yeah.
And I thought to myself, we both said it. That just doesn't, seem credible. And
well,
now
it wasn't.
Well, no, it wasn't, was it? And look where we are now, 1.4.
Yes, exactly. Just for good.
No, 0.7.
Yes, it got revised lower, didn't it, to 0.7. Again, there's a lot of noise in this data from the government shutdown and all the rest of it. And again, it's 3.5 months old at this point, so I don't think there's much by way of signal that we can extract from it. But again, it will be used to provide a bit of a baseline as to where the economy was pre-conflict that we can then compare the impact of the conflict to ultimately. So it will be interesting. Is it going to move the market? Almost certainly not.
No, but it's a momentum trade, isn't it? You've gone from, sort of you've gone from 4.4 to 0.7, and now you're hitting an energy shock in Q1.
Yes, albeit the 0.7 does have a record long government shutdown in it. So, that you do need to take that into account as well. But I do agree with you. The trend was sort of weakening before the energy shock came into the mix as well.
So do we know roughly how much economic activity was taken out of the US economy? Was that measurable? So, for
by the
example, instead of
government
being
shutdown.
0.7, what would it have been without the government shutdown?
I think the rule of thumb is normally 10 to 15 basis points for every week. So if you assume
6 weeks,
7 weeks, 6-7 weeks,
weeks.
you're kind of looking at somewhere between 0.7 and 1%, roughly. That is a very rough calculation. Please, any economics people don't come for me on that one. But yeah, that's essentially what you're looking at in terms of lost output that should, incidentally, be added back on in Q1 because the government has reopened again.
Government's reopened, SNAP payments have been restored, but those SNAP payments now don't go anywhere near as far because, obviously, of higher petrol, gasoline prices. So,
and food prices are probably going to be going higher as well. So
exactly, along with packaging costs. Before we get on to Delta, I'm not going to do Constellation Brands or Levi Strauss. You can read about it on my Substack if you're really that interested. Let's talk about Tesla, because they're trading sharply lower after their Q1 deliveries missed estimates.
have they run out of charge?
Oh. Well, probably because it costs much more expensive to basically power the energy, the battery chargers.
This is true. Sorry, before I made that terrible gag, you were going to talk about delivery numbers, weren't you?
Yeah, 358,000 compared to 372,000 expected. I've been reading anecdotal evidence that inquiries for electric vehicles have been going up because of the price spike, which seems rather counterintuitive when you consider that if you want to charge your car up, the charging infrastructure needs oil and gas.
Well, yeah, quite. I mean, when has...
So you're going to pay more by way of charging your car by a charger because of higher oil and gas prices. So what money are you actually saving by buying an electric car?
I don't quite understand that one either. But yeah, I mean, Tesla, if we closed here, I think it'd be the worst day in a couple of months for the stock. It is the second straight quarter that they've missed expectations in terms of deliveries. But are they a car company anymore? They've already stopped selling a few models. Elon Musk's very much kind of pivoting towards this AI, autonomous, robot-driven future. So actually, there is kind of a school of thought, and this is certainly what Tesla bulls will be saying, which is that actually the number of cars they sell doesn't really matter anymore because they're doing bigger and better things that are going to go and change the world one day. So, that would be what the bullish view was. The bearish view would very much be along the lines of the trend is clearly weakening here. That's not a great sign for the stock. The truth is probably somewhere in the middle, you guess.
It has been weakening pretty much since those peaks in December. Lower highs and lower lows. So certainly momentum is starting to stall. But then again, I think his focus is now much more on SpaceX, given the fact that they filed for their IPO, I believe.
They have, yeah. It always makes me chuckle this. There was news yesterday that they filed confidentially for their IPO. Well, it's not that confidential because it's on the front page of every newspaper. But yes, they have. And that will be happening presumably at some point this year. I'm still... I don't know, maybe it's slightly different now that they have actually filed, but I would not be at all surprised if all of this just ended up coming under the same umbrella at some stage in the future.
Well, certainly X is coming under the AI umbrella, given the fact they've just suddenly brought in and changed their charging structure.
Yeah, last week, wasn't
Pro
it?
X, which really pissed me off.
Especially to do it without any warning. That was outrageous. But so you've already got X and XAI are in the same group. SpaceX will probably end up in there. Tesla in the mix as well. You wouldn't rule it out, would you?
Well, that's the thing. Musk talks a good game about, looking after his customers and what have you. The way this particular subscription change has been brought about leaves a really bad smell and leaves a bad taste, I think.
Well, yeah.
And he just seems completely indifferent to it. He hasn't commented on it at all.
No.
Because I tweeted him, and I'm sure a whole load of other people have as well. Anyway.
Yeah.
Delta Airlines, first quarter numbers 2026. I mean, obviously airlines are at the front line when it comes to increases in jet fuel prices, and certainly those comments from President Trump earlier this week. Yeah, we've got plenty of jet fuel. You can buy it from us.
Yeah. Well, I mean, that's a lie for a start. They don't. The other thing is, of course, many years ago now, a lot of the US airlines, if not all the US airlines, stopped most of their jet fuel hedging. So they are a lot more exposed to this than they would have been, 5-10 years ago. I think this is going to be very much a situation where the guidance and the commentary is of much more importance than the figures that Delta announced themselves. Market participants are going to be asking questions around, as you say, how does the impact of those what is the impact of those higher jet fuel prices? What are you looking at in terms of demand trends, how that may change moving forwards? Are you going to have to be cutting your schedule as a result of, trying to manage demand given the price hikes that we're seeing? The airline sector is clearly very, very vulnerable to an energy price shock, not only in terms of input costs for the airline, but also in terms of demand, certainly leisure demand. If we are looking at a prolonged slowdown in consumer spending, leisure demand is clearly not going to be performing particularly well. So I think it will be instructive what Delta have to say in terms of looking to the future. And also the market will just read across from Delta to United to American Airlines to JetBlue to basically the entire industry, I think.
I think you've got to be very selective, on an airline to airline basis, because obviously if you look at Delta, most of their routes avoid the Middle East by virtue of the fact that they're being transatlantic or trans-Pacific.
Yes.
As well as Latin America, but others may not be so fortunate. They reckon that Q1 revenue will increase by around 6%, and premium revenue and cargo also saw increases in their previous results. So generally, sort of retail revenue doesn't tend to be a money earner anyway. And obviously also, as you said, depends on how much they've hedged. Now, I don't know what Delta's hedging numbers look like. I do know what EasyJet's hedging numbers look like, and they're pretty much hedged all the way up to the back end of the year.
Yeah. So they have a much better likelihood of sort of weathering the storm, so should we say, without having to have, huge price hikes.
Yeah, assuming obviously that we get a resolution to this in the next 2 or 3 months. But I think whatever happens, we're going to have to get used to much higher oil and gas prices, even if this particular thing is resolved fairly quickly, because they're not going to go back to where they were.
No, and I mean, you think about what is in the price. At the moment, you've got this huge amount of supply disruption that's being priced in, which is driving, Brent and WTI to $110, $120 a barrel. You've also got a huge geopolitical risk premium priced in. So you've almost then got to work backwards and go, how is this priced out? So, when energy flows do resume, yes, prices will come lower, but there's damage to infrastructure that needs to be repaired, which will have to, is put upward pressure on the price. There will still be a degree of geopolitical risk premium priced in greater than that we saw prior to the conflict. The other thing that you've got to think about is strategic petroleum reserves. Countries around the world are releasing 400 odd million barrels of crude out of their reserves. They have to be bought back again at some point in the future, because obviously you need to top up your reserves and have them there for the next rainy day, the next time you need to tap into them. So, I'm not going to sit here and make a prediction as to where crude benchmarks trade in 6 months' time, because that's utterly futile at this point. But you would imagine that the baseline for where we trade post-conflict is higher than where we traded pre-conflict.
Assuming you have any reserve capacity to speak of.
Well, that's a completely
unlike
different
the UK,
story.
which only has about 3 or 4 days gas reserve, because of the fact that numpties like this particular government and previous ones decided not to invest in storage capacity because they thought that they could rely on their neighbours. Well, unfortunately, in times like these, the only people you can rely on are yourself.
Yeah, exactly that. And that's the whole sort of peace dividend idea, isn't it? And actually, I think we're
I think that's gone.
sort of paying the cost of it by now.
I think that's gone now.
Oh, yeah, absolutely.
I mean, to a certain extent, you can rely on certain partners, but at the end of the day, each individual country in Europe has to serve their own voting base first.
Yes. And we're not going to argue it now because this is a financial markets podcast, not a political science one. But, that is the way of the world, unfortunately. Everyone is going to look out for number one first, certainly at a time of crisis.
Well, that's what they're mandated to do.
Yeah, exactly.
It's just a pity this government can't see that. They tend to put they don't tend to put their own voting base first.
No,
it's always virtue signalling, wokery, and nonsense. Anyway, on that note,
what a line to end with, Mr.
I was actually going to talk about Levi Strauss and Dockers, because you like to keep them. You like to keep Levi Strauss.
What? Because I'm wearing a pair now.
Well,
And I got papped outside the jam pot wearing a pair yesterday.
I saw that yesterday. You did look rather quizzical at the camera.
Might have been the 5 pints I'd had before that picture was taken rather than Ryan, but there we are.
It was the old.
Anyway, Levi Strauss.
It's Levi Strauss.
I haven't bought any lately, so I'm not propping them up this quarter.
Well, let's just say what their guidance is. Mid to single digit top line growth and some margin expansion on an adjusted EBITDA basis. 140 to 146 a share is their full year guidance, but this is their first quarter numbers. So I think there could be some downside risk to that.
There we go. Time will tell. When do they report next? What is
7th of April.
Next Tuesday.
First quarter.
Perfect.
Right. Okay. Well, on that note, I think it's best to say we can wind it up here. Wish everyone a happy Easter.
Yes, indeed.
Don't trade non-farm payrolls because it'll be thin as
my hair.
Anything. And see you all same time, similar place next week. Probably have to do it Friday morning, Michael, because I got a hospital appointment on the Thursday. So
absolutely fine. So yeah, happy Easter, everyone, and we'll see you next week.
Yeah, don't eat too much chocolate. I know I will be. So there you go.